Good morning, everybody. It is Monday, December 1, 2025. I am Herb Morgan, Senior Managing Director, Chief Investment Officer, Cantor Fitzgerald Managed ETF Portfolios. This is my weekly economic and market commentary. As a reminder, you can follow me intra-week on LinkedIn by following Herb Morgan. This presentation is designed to be used by both investment advisors and individual investors, but of course, both are expected to make their own investment decisions. Nothing in the presentation should be treated as investment advice, tax advice. There are no recommendations for the purchase or sale of securities. Everything is for informational purposes only. The views expressed herein are mine and mine alone, may differ from CFIA's parent, affiliates, or other portfolio managers at the firm. We had one of those great weeks where there was nothing red. All of the equity indices positive, all of the bond indices positive, and our friends in the non-correlated space, the alternative indices, also all positive. We had a growing consensus last week that A, the Fed will cut rates on December 10th. B, inflation is likely progressing closer to the 2% goal. And C, while there are weakness in the labor market, it is not necessarily pointing to recession. All of that combined drove markets higher last week. Let's start with September retail sales. Expected to go up 0.4. They were up 0.2. That's good. Back out autos and gas up 0.1, also pretty good. Nothing wrong with retail sales in the month of September. Then we got the PPI for the month of September, up 0.3%. We got a great, decline in August. That was really great. But the year over year is 2.7. Remember, the Fed's goal is 2.0 core. Core PPI was up 2.6. That was a little bit better, 0.1 better than expected. So directionally good, basically not the greatest, but good news there. We move into housing prices. The September reading from the Federal Housing Finance Agency, or FHFA, was unchanged. So housing prices did not go up or down by this metric, but they are up 1.7. That's below the 2% objective on a year-over-year basis. The Case-Shiller Home Price Index, which measures a similar thing, up 0.13 and 1.36 on a year-over-year basis, also below that 2% number. So while we're on the inflation story, let's talk about it a little bit. I grabbed 4 sort of random items off my Bloomberg terminal over the weekend. Let's start with retail gasoline. That affects just about everybody, right? And we were, let's say, back in March at a high nationally at 3.25. Now, for those of you in California, or more specifically San Diego, it's been decades since we've seen 3.25. We routinely pay over $6 a gallon. But the point that I'm making here is you can see the directionality from 3.25 now down to 3 on a national, and a very steep rollover in prices. Gasoline affects the price of everything else. And it's been a focal point of the administration to try to drive down gasoline prices. It appears they're having some success. Owner's equivalent rent, a very important component to the CPI. The year-over-year change here, now below 4%, still needs to go further, but you can see where it's come from, about 8. And then for those of you looking to see, well, how about, since the new administration maybe came in January, you can see that there. Moving on to chicken, just good old chicken, skinless chicken breasts per pound. A couple of typos there, sorry about that. You can see here the price per pound has not gone down. We haven't received any in the food prices, and perhaps that's why you're seeing some of the sentiment reports, the consumer sentiment reports, not doing so well. Auto insurance, another big one, which had been on a tear of annual increases, up and over 20% annualized, now down below 5% on a year-over-year basis. So I'd say if you look at this, you'd say 3 out of the 4 that I randomly chose are showing progress. Likely that the 3 out of 4 can drag the other one down. Why? Perhaps the Fed is starting to feel more confident on the directionality of inflation, and is more likely than not at this point to cut rates on December 10th. But consumers aren't there yet, despite the lower gasoline prices in 49 out of 50 states, despite auto insurance rates going up less. There's still a very high cost of food, very high cost of energy as we move into the winter season, heating costs. And consumer confidence is at 88.7. That was well below the estimate. It's down there at the COVID levels, so people aren't feeling pretty good. Present situation fell a little bit. Expectations did as well. Home sales pending from the National Association of Realtors up 1.9% after basically flat in September, but are still below where they were a year ago. This was probably one of the biggest items of good news on the week. It was the weekly claims for unemployment dropping to 216,000, which is the lowest reading since April. That's good news, but it's also the survey week, which will be used statistically in the compilation of the Bureau of Labor Statistics non-farm payrolls report, otherwise known as the jobs report. We'll get that, of course, on Friday. That was a good number, suggesting that perhaps the jobs report coming up this Friday will be better than expected. Durable goods orders up 0.5%. So durable goods are doing fine, backing out transportation, really great, up 0.6%. Capital goods orders up 0.9%. This is a volatile series. 1 month is not a hurrah, hurrah, ollie, ollie, oxen type of reading, but it's a good reading, and we're happy to have it. On the not so good side, we got the Chicago Purchasing Managers Index. It fell to 36.3, way below the estimate. Also similar to these readings back during the COVID time. It's only Chicago. It's only one region. It's not the whole country. But when you see new orders drop significantly and employment drop significantly, you do raise an eyebrow, and you want to continue to look at it as you go forward. We're done. Let's just call it done with quarterly earnings report. We've got a couple of big names this week, such as Salesforce is this week. That's a big company. But we're basically done. 485 of 500 average earnings surprise above the analyst estimates is about 6%. Across the board, everything's strong. The exception of communications, just barely under, but big numbers in consumer discretionary, which is suggestive of, hey, the economy's not as bad as we thought. Even though those sentiment numbers are coming in low, perhaps the economy is a little more bifurcated. Those that participate in discretionary spending are saying, hey, things are fine, everything's good, the market's up, our portfolios are good. Healthcare spending is up as well. Okay, we move on to economic data this week. This morning, Monday, we're going to get the S&P Global Manufacturing PMI, expected to be above 50, but not aggressively so. Nice sweet spot there. ISM's number below 50. That, it'd be nice if they were both at 50 to show manufacturing expansion, but remember, manufacturing is about 15% of the economy. Services closer to 85%. Total vehicle sales for the month of November expected to come in about 15.5 million. We've got the ADP report, which looks downright anemic on Wednesday. Import and export prices balancing each other out. Industrial production flat. Utilization up a tad, expected to be. Then we've got the two service sector PMIs, both well above 50, showing the economy continued to grow, more likely than not, in the month of November. Weekly jobless claims expected at a very healthy, solid number of 222. Personal income and spending on Friday, PCE index and its core brethren, 0.2 on the core is the expectation. That's a good number too. That's the kind of number that will give the Fed, hey, we're only a week before the rate cut. If that comes in at 0.2 or maybe 1/10, they can feel confident with that 25 basis point cut. Consumer sentiment and consumer credit. Remember, there is a lot of economic data that hasn't been released, even though the shutdown is concluded. It's unclear exactly when it will be released. On my terminal, it has like a range, like a 2-week date range from a number of pieces of data. So it just gives us a little extra level of uncertainty in the market. We don't know when it comes. We might go in on a Tuesday morning and there's some piece of data that could be really good, sending the market higher, really bad, sending the market lower. We just need to be aware of that over the next couple of weeks as the government catches up on those data releases. Don't forget, you can hear this audio version on all the different formats. Video is only available on the YouTube. And I know earlier in the recording, I said we would get the big jobs report on Friday. Incorrect. It's actually next Friday. Thanks, everybody. Be back to you again next week.